Hey, it's Tom here and welcome back to the channel. So this is going to be part 2 in what I think is now going to be a 3-part series on the channel around Alibaba and some of the kind of key questions and things that come up as it relates to Alibaba from an investment perspective. So if you haven't already seen part 1, definitely go and check that out. And a massive thank you to everyone who did watch that video. That video from my perspective smashed a few records in terms of the number of views that it got on that video. I think that had close to 8 or 10,000 views in the first 24 hours, which is certainly a record for this YouTube channel. So I really appreciate that and all the kind words in the comments, and I think we had like a 99% thumbs up rating on that video as well. So thank you all very much for that, but we've got more work to do and we've got more topics to kind of get through with Baba. So last time we talked about the delisting risk. We also talked about the VIE/ADR structure with Alibaba, and also talked a little bit about the Hong Kong listed version of Baba as well. So in this video, I want to touch on some of the antitrust fines that Alibaba have been hit with, about a $2.8 billion fine, and also discuss what Alibaba actually did wrong to get that fine in the first place, as well as some changes that they're making kind of moving forward, and whether we should expect fines to be kind of an ongoing thing for Alibaba or not. Also want to talk about a pledge, so not necessarily a fine, but a pledge that Tencent have actually announced just in the past couple of weeks. I want to touch on tax rates. So there's been some pretty material changes in the effective tax rate for Alibaba, and not in a positive direction. So tax rate has been going up for Alibaba and probably will continue to do so over time. So we'll talk a little bit about that. And I also want to touch on some of the carnage that happened with some of the Chinese education stocks earlier this month. And in the next video, which will be the third and final sort of video in this Alibaba series, I want to talk through share buybacks and also my estimate of intrinsic value for Alibaba as well. So if you do like the video, hit like on the video, and also consider subscribing if you haven't already. Like I mentioned in the previous video, I'm going to be giving away a copy of Poor Charlie's Almanac back here at 30,000 subscribers. So if you can help us push towards that goal of 30,000 subscribers, that would be much appreciated. And I will release further details on how to get in the draw to win that book once we hit that milestone. Okay, so let's kick it off by talking about the big $2.8 billion fine that Alibaba got hit with earlier in 2021, and kind of what actually went wrong and what Alibaba did to receive that fine. So it was basically because of this. Alibaba had this practice which in Chinese, and I'm going to mispronounce this, but I'll put the spelling and everything up on the screen here so you can see that. In Chinese, they did what is called Zhuan Yi, and that basically means pick one, not two. And it was kind of a message that went out to a lot of the people selling items on some of the Alibaba platforms. So you may be familiar with this already, but Alibaba is a very large e-commerce business which has several subsidiaries that operate in different kind of areas of e-commerce. So the big ones really are Taobao, which is a website where basically individuals can sell items online, and they also have Tmall, which is more of an online mall type shopping experience where you have a lot of kind of big name brands on the platform. And for Alibaba, those are very large, dominant businesses in the whole sort of China e-commerce ecosystem. And Alibaba really were kind of taking advantage of that and putting a lot of pressure on people choosing to sell on their sites. And they said basically you just have to pick one platform and kind of stick with that. If you want to sell on Taobao and then also go sell stuff on some other Chinese e-commerce site, we're not really going to be happy about that. Now that is clearly an anti-competitive practice, and that is what drove the fine that Alibaba received. And Alibaba were doing this so aggressively and so sort of tactically that they also had this sort of grey list of people that had listed their products on an Alibaba platform and then had gone and listed them also on another e-commerce platform. And it was at the point where they had in many ways sort of automated this process of finding people who were putting the same products on multiple sites and not just listing them on Taobao or Tmall or whatever Alibaba platform we're talking about. And sellers that were put on this grey list by Alibaba actually also saw drops in their own sales from, selling their products on these Alibaba platforms. And that was basically because when people would look up a product on an Alibaba platform, if that particular seller was on the grey list, their products would appear lower in search results. So as a result, Alibaba was found to quite clearly be in the wrong here, and they were slapped with a fine. Now, In terms of what the fine actually entailed, there was a figure that was quoted by People's Daily Online, which is the sort of official newspaper of the Chinese Communist Party, the CCP. And on that article, on that sort of post that they put up, they said that the fine was 4% of 2019 sales from Alibaba. Now, the reason that that metric was put up and the reason it's kind of important is that fines of this nature in China are actually limited to 10% of sales, 10% of revenue for any given year. So Alibaba were not slapped with sort of the maximum penalty. They were given a 4% fine in terms of their annual sales for 2019 versus the maximum of 10. So they weren't slapped with the maximum fine, but it was a very large fine nonetheless, 2.8 billion in US dollar terms. That compares to about 975 million, which was the previous largest fine handed out by the CCP up until this point, and that was actually handed out to Qualcomm, of all businesses. Now, in terms of the impact on profitability, it's actually quite an interesting exercise to kind of walk through some of the numbers here. So Alibaba has kind of had a little bit of a bumpy ride in terms of their profit margins over the last few years, but their profit margins have been anywhere from about 15% at the very low end, right up to about 30% at kind of the high end. So it's quite an interesting exercise just to walk through, what happens if Alibaba actually get fined every year? Can they get fined to the point where they just go bankrupt and they can't keep up? And what I found with just some kind of basic back of the envelope maths is that, if Alibaba is making a 15 to 30% profit margin and the absolute maximum fine they can get is 10%, if they get fined to the absolute maximum every single year, they are still going to be profitable. So, if they have a really poor year and their profit margins are only 15% and they get a 10% of sales fine, 15 minus 10, they still have a 5% profit margin on their business, right? So that would clearly not be a good thing, but it hopefully just puts into perspective the earnings power that Alibaba does actually have in place. Now, in terms of more fines potentially coming through for Alibaba in future, there's a few kind of things to consider. So in a business highlights kind of release from Alibaba for the quarter ended March 31st, 2020, they described the $2.8 billion fine as a one-off fine. Now, I sort of think that that is more of an accounting term than anything, that it's kind of a one-off cost as they view it. That did kind of get picked up by media a little bit, and that was reported in a few articles that Alibaba were viewing this as kind of a one-off thing. I'll talk about some of the changes they're making in a sec, but I tend to think that's more of a sort of accounting term than actually necessarily being a one-off thing. But it was interesting. So alongside the actual fine of the 2.8 billion US dollars for Alibaba, the other thing that came along with this penalty was, as it's described, Alibaba has to carry out a comprehensive revamp of its operations and submit a self-examination compliance report within the next 3 years. And then Alibaba actually went on to release a statement that said, Alibaba said it would accept the fine with sincerity and would strengthen internal systems to better serve our responsibility to society. The penalty issued today served to alert and catalyze companies like ours, Alibaba said. It reflects the regulation's thoughtful and normative expectations towards our industry's development. So that's fairly political talk from kind of my perspective, but by all accounts, it does look like Alibaba is looking to change some of their practices in order to avoid things like this in the future. Now, another bit of interesting news I've kind of stumbled across in my research recently is actually a pledge that another Chinese business has made recently, which is Tencent. And Tencent, for those who don't know, is the owner of WeChat. WeChat is kind of like the everything app in China. It's like your messaging, your social media. You can do payments through it. You can do gaming. People don't even kind of use email in China to a large extent. They talk to each other even both personally and professionally kind of through WeChat. So it's a huge app, massive user base, and Tencent, as a result, is a very, very large business. It has quite a significant market cap. But one of the interesting things that has come out about Tencent is that they have said that they will pledge around 7.7 billion US dollars to sustainable societal innovations, whatever that means. And we'll get into a bit of a discussion on that shortly. But as a result of that, there was a lot of news articles floating around that, Tencent is giving away 50% of their net income. So if you look up the net income for Tencent, for whatever reason, it's a little bit tricky to find kind of updated years without actually going directly to the company reports. But in 2019, which seems to be the number that a lot of articles are quoting for whatever reason, Tencent's net income was about $13.5 billion US dollars. So if they're pledging or giving away, or however you want to describe it, 7.7 billion out of about 13.5, that's more than 50% of their net income on that sort of metric. So when I first read that, it really had me thinking that Tencent are really just giving away a lot of their earnings every single year. But upon further investigation, and I have to give a shout out here to Investing with Frank, who put up a good little tweet thread kind of on this topic. He dove a little bit more into the details of what Tencent are actually doing here. So the first thing to keep in mind is that there was actually no time frame given around this pledge. So I don't expect that we'll see 7.7 billion being given away each and every year. This is probably like a big headline number that they've put out that will sort of be slowly given away over a number of years. But nonetheless, it is still quite a significant sum of money. Okay, so let's talk now a little bit about tax rates, because China do have some quite interesting policy when it comes to corporate tax rates on what they call their key software enterprises, and also on software businesses in general. So this is basically the policy in China, and this comes directly from PwC in China, PricewaterhouseCoopers, which is obviously one of the big accounting names, not only in China, but worldwide, actually more so. So PwC basically say that software enterprises can enjoy a 2-year exemption and a 3-year half reduction on corporate income taxes, as well as key software enterprises can enjoy 10% preferential corporate income tax rate if they are not enjoying the previous tax exemptions that I mentioned in that particular year. So very, very low corporate tax rates of only 10%. For the average Chinese business, the corporate tax rate is actually 25%. And it looks like when it comes to Alibaba's businesses, there may be some that are no longer sort of qualified for these lower tax rates. So just to give you a bit of a feel for some of the actual requirements, in terms of personnel, the guidelines stipulate that companies must have at least 40% of their employees with a bachelor's degree or higher. Furthermore, research and development professionals need to account for at least 25% of their headcount. The research and development spend of qualifying companies must also account for more than 7% of total revenue, as opposed to the traditional 6%, and income related to software product development should account for at least 55% of revenue from a previous 50%. So some slight adjustments in terms of tax policy out of China. And the other thing to keep in mind is that Alibaba have a range of different subsidiaries, all in different sort of business segments. So as I understand it, there's not going to be sort of a blanket treatment across Alibaba generally. Rather, this is going to be done on sort of an individual subsidiary kind of basis. And if we look at some of the numbers now starting to actually flow through for Alibaba, they said that because of these tax benefits, they paid an 18% effective tax rate for fiscal 2021, but they expect that to rise to between 23 and 25% by 2022. So by 2022, they expect to be right back up to almost the normal corporate tax rate of about 25%. Okay, so the final thing I want to talk about in this particular video is about some of the drama that happened with education stocks, or Chinese education stocks specifically, just a few weeks ago. So we had some new regulation out of China as it relates to some of these for-profit education businesses that sent these stocks down significantly. And by significantly, I mean that if you look at a stock like TAL Education, you'll see it's down about 95% on this news. So it's down massive. It wiped out about a decade's worth of returns pretty much instantly. And it was huge kind of, for a lot of people, seemingly out of the blue news. For some that were perhaps a little bit more informed on the for-profit education sector, maybe it didn't come as quite as big a surprise. But nonetheless, it was pretty big changes. And these key changes were that, one, these businesses now have to basically operate as non-profits. So non-profits do not trade at particularly high prices in the stock market generally. investors are buying into pieces of ownership in a business in order to get a portion of the profits over time. So if you're a non-for-profit, you're not going to have a particularly valuable stock. And also there was a ban on basically foreign investment in some of these businesses as well. So really dramatic news, and I want to kind of talk about why I think that may have happened and whether we can potentially expect this for other industries moving forward. And I am by no means an expert on for-profit education businesses and even the education sector more generally. But someone who is a guy by the name of Monish Pabrai. He's an investor that I follow extremely closely, and he's someone who knows the education sector very well. His foundation, the Dakshana Foundation, basically pulls really bright kids out of poverty and trains them up to do things like the IIT exams in India in order to go on and become doctors and engineers and, very high earning individuals. And these are people that are generally coming from families that have extremely low incomes. They're coming out of poverty, families that earn $50 or $100 a month kind of thing. So here's someone that knows the education sector extremely well. And in one of Monish Pabrai's talks that I actually found here on YouTube the other day, he basically gave his thoughts on this whole debacle as it relates to Chinese for-profit education companies. And I'll leave the full video interview with Monish Pabrai down in the description below as well. But Monish Pabrai's take basically on this whole thing is that over time, the for-profit education sector has kind of boomed in China. And it's not just boomed in terms of an expansion in kind of student numbers. It's really also boomed because of a massive drive up in prices for, students to be tutored. And it's gotten to the point now where education prices are so high and the costs to have children and have a family are so high that it's really putting people off having reasonable sized families. And that is really not a philosophy that aligns well with the CCP's goals of, pulling people out of poverty. So to Monish Pabrai, it really wasn't a surprise that there was a crackdown in this industry. Now, if you compare that to a business like Alibaba, Alibaba, I would hope, is kind of on the other side of the spectrum here, where they're allowing people in poverty to start businesses and actually earn some money, and it's pulled a lot of people out of poverty over time, I would argue personally, but it's certainly a very, very interesting case study to follow. And as a bit of an aside from Alibaba, I actually have a small shareholding in a business called the A2 Milk Company, and the A2 Milk Company makes a lot of its revenue from infant formula sold in China. So this has actually been a bit of a headwind for the A2 Milk Company as well. There's not as many babies being born and not as much infant formula being consumed as there has been potentially in the past. So if this can be sorted out and people start, having more families in China and so on, that could actually be quite a significant tailwind for the A2 Milk Company as well. So that's it for me for this video. We've covered a long list of topics now as it relates to Alibaba and Chinese stocks in general. So I hope you're enjoying the series so far. We have one episode left in the series, which is going to be looking firstly at share buybacks quickly and also at my intrinsic value assessment for Alibaba. So if you enjoyed the video, please hit like on it and also consider subscribing. Like I said at the start of the video, at 30,000 subscribers, I'm going to be giving away one of these bad boys back here, a copy of Poor Charlie's Almanac. So that's for me for this one, and I will see you in the next video. Cheers.